Between 2014 and 2018, Warren Buffett's wealth grew by $24.3 billion. His true effective federal income tax rate during those 5 years was 0.10%. That number is not a typo. It comes from ProPublica's secret IRS files investigation. In 2021, ProPublica obtained actual IRS tax return data for thousands of America's wealthiest individuals. This was not estimated, not modeled. It was the real filings. The investigation introduced a concept they called the true tax rate, which is different from the effective rate shown on a return. The standard effective tax rate divides taxes paid by reported income. ProPublica's true tax rate divides taxes paid by total wealth growth, including unrealized gains that never appear on a return at all. That shift in denominator is everything. The comparison across billionaires is instructive. Buffett 0.10% true rate, Jeff Bezos 0.98%, Elon Musk 3.27%, George Soros 0.00% in 2 of those years. These are not outliers. They are the logical output of a coherent system. Before we go further, a clear line. Tax evasion is illegal. Deliberately hiding income, falsifying records, or misrepresenting facts to the IRS. What we are examining today is tax avoidance. The legal use of code provisions that Congress wrote, the President signed, and the IRS enforces. These are not the same thing. There are 3 mechanisms that structurally produce these rates. Mechanism 1, deferral through unrealized capital gains. Mechanism 2, charitable giving with appreciated assets. Mechanism 3, the long-term capital gains preferential rate. We will take each in sequence. Mechanism 1, Buffett has held Berkshire Hathaway Class A shares for decades without selling them. Under IRC Section 1001, a taxable event, a realization, only occurs when an asset is sold, exchanged, or otherwise disposed of. Until that moment, no gain is recognized, no tax is owed. Buffett's Berkshire stock appreciated by billions over those years. That appreciation compounded annually inside the position. Because he did not sell, none of it was reportable income. The IRS had no claim on it. The wealth existed. The tax event did not. This is not unique to Buffett. Any investor who purchases an asset and holds it accrues unrealized gains indefinitely. The deferral itself has a compounding advantage. Every dollar not paid in tax today continues working in the portfolio. The longer the hold, the larger the effect. The scaled-down version for a WB2 earner making $200,000 to $600,000 annually. Hold broad market index funds in a taxable brokerage account and do not trade them. A total market index fund that you never sell behaves structurally identically to Buffett's Berkshire position in this regard. The discipline required is behavioral, not technical. The tax code rewards inactivity in a taxable account. Every unnecessary sale, rebalancing, chasing performance, responding to volatility, converts deferred gains into a current tax liability. The system punishes trading in taxable accounts and rewards stillness. Mechanism 2. Charitable giving with appreciated stock. Since 2006, Buffett has donated tens of billions of dollars in Berkshire Hathaway shares directly to the Bill and Melinda Gates Foundation and 4 family foundations under his Giving Pledge commitment. The structure of these gifts is as important as the scale. Under IRC Section 170E(1), when you donate appreciated capital gains property held more than 1 year to a qualified public charity, you receive 2 simultaneous benefits: a deduction equal to the asset's full fair market value, and you owe 0 capital gains tax on the embedded appreciation. You never sell, you never trigger the gain. Compare this to the alternative: selling the shares first, paying capital gains tax on the appreciation, then donating the after-tax cash. That route pays the IRS 20% or more before the charity receives anything. Donating the stock directly eliminates that intermediary tax event entirely. The annual deduction limit for appreciated stock donations to a public charity is 30% of adjusted gross income. Unused amounts carry forward for 5 years. This is not a corner case in the tax code. It is a statutory provision designed explicitly to encourage the donation of appreciated property. The accessible version for ordinary high earners is the donor-advised fund. Fidelity Charitable, Vanguard Charitable, and Schwab Charitable all offer DAFs with no minimum contribution at account opening. You transfer appreciated stock from your brokerage into the DAF. The DAF sells it internally tax-free and you grant proceeds to charities over time. The DIF strategy is particularly powerful for a high earner who has held employer stock, RSUs that have appreciated significantly, or any position with a low-cost basis. Rather than selling and paying capital gains, transfer the position to the DIF, take the deduction in the year of transfer, and decide which charities receive grants over the following years. You do not need to be giving Berkshire shares by the billion to use this mechanism. A 37-year-old earning $400,000 in W-2 income who donates $40,000 of appreciated index fund shares to a DAF instead of cash has accessed the same structural provision Buffett uses. Scale down, functionally identical. Mechanism 3. The long-term capital gains preferential rate. Under current law, income from the sale of assets held more than 1 year is taxed at 0, 15 or 20% depending on total taxable income. For most high earners, the applicable rate is 20%. The top ordinary income rate is 37%. This differential is not accidental. It has existed in some form since the Revenue Act of 1921, argued on the premise that it encourages investment and risk-taking. The economic merits are debated. The legal reality is not. Capital gains income is taxed at a structurally lower rate than labor income. That is the code. For Buffett, the implication is compounded by the nature of Berkshire's income. When he does realize gains through Berkshire's portfolio transactions, dividends, or occasional stock sales, a significant portion is subject to the 20% rate rather than 37%. Even his realized income benefits from the preferential rate. For a W-2 earner, capturing the 20% rate requires one thing: holding period discipline. Any asset held more than 1 year qualifies. Index funds, individual stocks, real estate. The 1 year threshold converts a 37% ordinary income event into a 20% capital gains event. That is a 17-point differential on every dollar realized. One related provision worth noting: the net investment income tax under the Affordable Care Act adds 3.8% on top of the 20% for high earners above $200,000 single or $250,000 married. Effective top rate on long-term gains is therefore 23.8%, still 13 points below the 37% ordinary rate. Now let us hold all three mechanisms simultaneously. Unrealized deferral means wealth grows without a taxable event. Appreciated stock donations eliminate embedded gains while generating deductions. The preferential rate reduces tax on whatever gains are eventually realized. Combined, these provisions interact to compress the effective rate towards zero for someone operating at Buffett scale. There is a survivorship bias note that belongs here. The people we are discussing held assets that appreciated massively over decades. The strategy of holding and never selling only works if the underlying asset performs. Buffett's Berkshire compounded at roughly 20% annually for 60 years. That is not replicable as a premise. The tax structure is accessible. The asset performance is not guaranteed. The broader structural point: the three mechanisms we have described reward capital over labor. A person earning $500,000 in W-2 salary pays 37% on the marginal dollar. A person who accumulated $500,000 in appreciated stock pays 20% when they sell and 0 if they hold or donate. Same dollar amount, different origin, different rate. That is policy design. Buffett himself has stated this publicly and repeatedly. He's famous for noting that his secretary paid a higher effective tax rate than he did. He has advocated for changes to this structure. He operates within the law as written, calls attention to the asymmetry, and continues to benefit from it. That is not hypocrisy. It is an accurate description of how systems and individuals interact. For the high earner watching this, the actionable takeaways are narrow and specific. 1. Hold appreciated positions in taxable accounts longer than 1 year and ideally indefinitely. 2. If you give to charity and have low basis stock, do not sell first. Transfer shares directly to a donor-advised fund. 3. Understand that your W-2 income is taxed at the highest rate in the code. Capital income is not. None of this requires sophisticated structures, offshore entities, or legal complexity. A Fidelity brokerage account, a Fidelity Charitable DAF, and holding period discipline are the instruments. The complexity lives in the tax code, not in the execution. What requires effort is the behavioral discipline to not act when the market moves. The conclusion is structural. The 0.10% rate is not a hack. It is not creative accounting. It is the logical output of a tax code that has, for over a century, treated capital appreciation differently from labor compensation. You may agree or disagree with that as policy, but you are inside the system either way. The only question is whether you understand